All right, market structure, order blocks, Fibonacci. Right, you already know what order blocks are. You probably don't know what Fibonacci is or what market structure is, right? So Fibonacci, firstly, Fibonacci is this symbol here, this tool here. You'll find yours. You'll find looking differently. I've modified mine to only have these levels: 0, 50, and 100. And basically, right now, the only thing that you need to know is how to use this thing, as how it came to be or things like that. We'll get to that before we go, right? So this is a Fibonacci tool. I'll show you how to use it as we go right now. Okay. So now what market structure is basically tells you about how the market is moving. If the market is moving down this way, it means that the structure is downside, right? If the market is moving up, then the market is uptrending, downtrending, uptrending. And then if it's consolidating, that is, if it's moving slowly in the same place, then that is a consolidation or an accumulation. But for now, just think of it as the market moving sideways, right? So if the market is moving down, that's a downtrend. The market structure is downward. The market is moving up, that is an uptrend. The market is moving upwards, and the structure is upwards, right? Cool. So now how can you tell? So how you can start analyzing your market in terms of your market structure is basically by highlighting your highs and your lows, right? So we're going to start here, highlighting our high there, and then we're gonna go to, let's take this slow, right? And then what you want to see in a downtrending market is you want to see your lows being taken out and new lows being created. And basically how you can see that is in this way, right? You remember stop hunts. You want to see your stop hunts happening on the downside of your market. This thing doesn't want to click. Okay. You want to see your stop hunts happening on the downside of your market, right? So let's look at this. Cool. All right. If you take a look here, we have this low, and then we have that high, right? And then what this low is called now is called a higher low. Reason being, there is another low previous to that one, and this low is lower than this one. So this low is going to be called a higher low, and higher lows happen on an upwards market, but lower lows happen on a downwards market, right? And that's when you'll be getting your lower highs. So we have this high here, which is the highest point from this to that, right? This is the highest point, and that is your higher high, right? This is our highest most point, and it's going to be called HH, our higher high, right? And it's going to sit right there, right? And then right here we have our lower high. And again, there is a video for this, and I will link it. I'll put a link below this video. So this is our lower high, right? And then here we had our higher low, right? We had our higher low here, but then here we have our lower low, right? It's lower than this one, right? And this one is higher than this one. So what you want to see is this on a downward market. This is what you want to see, right? You want to see lower highs being created, lower lows being created, previous lows being taken out, while new lows are being created, right? Now, how can you use order blocks with your market structure? First things first, what you want to see is a break in the market structure. You want to see a stop hunt. So as soon as the market trades lower than the previous low, that is a stop hunt, right? You remember that this is a stop hunt. This is a new low being created right here. When a new low gets created like that, it means that the structure has been broken. This structure has been broken. New structure has been created, and this is now a new low. So now we're going to start using this one, right? So let me just clear all of this. Let me just clear all of this just so that everything is nice and clean. Right, cool. Now let's say right, that the structure here is downward, right? And then we are now here. This lowest low has been created. This lower low has been created, and then now you also have this lower high. Please imagine with me this lower high, right? Now imagine that the market is still sitting like that, right? Yes, it's still sitting like that. The new data is yet to be created, right? So when the market is like that, what you'll then wait for is for this low to be taken out. Wait for, sorry, for this high to be taken out, right? Signifying a break in market structure and a change in the trend, right? Remember, the trend was downward, but as soon as the market breaks above, it signifies a change in the trend, a change in the market structure, a change in direction. And then as soon as you see something like this, what you want to do is you want to take the Fibonacci, start from the lowest low to the newly created high, right? And then as soon as you do that, what you want to do now is this. For your imagination, what you want to do now is this. You're going to mark this point here like that, and then you're going to take this guy to the low. Now this one you're going to mark it as being red. Why, you wonder? Because we do not want to trade on the red zone. Above the 50% on the buying market, we do not enter. We enter below the 50% of our Fibonacci, right? And then what you want to do now, what you want to do next, right? You marked your places of buying and no buying, no entry, right? This is a no entry zone, no entry zone. Sorry, the red is a no entry zone, and then I'm gonna make it white. Right, the red, no entry zone. Is it gonna be visible? Yes. Right, the red is a no entry zone. Even if you see an opportunity on this side, you do not enter ever. Why? Because the market might trade lower, right? The market might trade lower, so you don't wanna be taken out that easily. And then what you wanna do now is you wanna look for an order block on the lower side of the market, right? You wanna look for an order block somewhere here. If you can find one, kudos, yay! Then you would have yourself an entry. You would basically just wait. Let's say this was our order block, right? Of which it is. This is the pattern that I was talking about, trace inside up, right? We have your last selling candle followed by 2 buying candles to engulf your previous selling candle, right? You would mark that guy from there to here, right, to the lowest low. You mark that like that, and then you put your buy limit right there, right? And then you wait for the market to move from that high to come down to your limit, to activate, and then to start moving up with you, right? Now imagine if you had used this order block here. Let's say maybe this was our order block here. You would have been taken out. I mean, like, that's just a waste of money. You would have been taken out. You don't want that. Even if you wouldn't have been taken out because your stop loss would have been probably lower, nonetheless, you wouldn't have been making money if you had been patient and waited for the market to come to you, right? So you wait for your market to come to you, then you enter, and then the market goes up, right? And then you basically do this over and over and over again. As the market moves up, you move up with it. As soon as it creates new lows, new highs, move up with it, right? Same thing right here. You do the same thing here. The market right activated your limit. This is where the market activated your limit, right? Right there. You just leave it like that, right? And then as it moves up, it breaks this high again. This high that it had created, it takes it out, right? it takes that high out. Have now higher high, right? As soon as it does that, you move with it, you wait for it to come back to you, right? Okay. Alright, the market is now moving up. You take your Fibonacci, lowest point being this one, and then you move up with it. It creates this high, and it pretends as if this one start going down. It's not. Gold creates another high, another high, another high. Notice our low is still in the same place, right? Why? Because we're moving with the high, going higher. Then what you do, remember again, same thing as before. This no trade zone. Do not enter here. Instead, you're going to enter right here. On this section of the market, that is where you're going to enter. Right. Simple as that. No trade zone. This, however, is our trade zone. Alright. I'm going to make it green. Cool. And then in here, that's when you go also, you look for another block, right? Where are we going to find another block? This is not another block, but this guy here is, right? This guy is another block, right? You let the market come to you, don't chase the market. When the market starts creating these swings here, don't mind the market, just wait where you're supposed to wait. Then the market is going to come to you nicely, activate, and then it's going to pretend as though it's going for a stop, but your stop will be right here, right? Why? Because you have to put your stop loss a few pips below the lowest low, of which on the order block, the lowest low is this guy, so we're going to put our stop loss right there. The market comes, taps into your order block, and it starts moving into your direction, right? That is all that you do. You never ever complicate this. That's all that you do. Market structure, Fibonacci, order blocks, boom, you're good to go.